Hello, this is the first in our series of a trading and technical analysis course. I'm David Jones. Welcome back to the latest video with me and Trading 212. Now, this week is going to be slightly different again. Over recent months, we've done a whole host of videos on technical indicators, charting, stop losses, market psychology, all of this sort of stuff. So we thought, well, the logical thing to do is do a total online charting and trading course starting right from scratch. So this is going to evolve over many weeks. We're going to start right off with the basics. So let me just explain a bit about this and the principles behind it. Many people, when it comes to trading foreign exchange markets and of course other markets, will look at technical analysis and charts. So that is going to be the bias of this course. You know, my background is very much in charting. I qualified as a chartist back in 1995. My first job was as a currency technical analyst and I worked in financial markets for 20 years. But it's not all going to be charts. You know, we are going to look at things like how fundamentals affect markets, trading around news events, and of course the all-important aspects of psychology and money management. But from today, let's start right from the basics and talk about charting and technical analysis. What it is, and maybe just as importantly, what it isn't. So first of all, what isn't it? It's not a magic system that's going to predict every move in the market. I think a common misconception, if you've never traded before, you start trading, you think if I can only get my charts right, my moving averages, my stochastics, my MACD, then untold riches is going to come my way. Clearly that's not the case. You know, that there's a lot more to trading than those foundations of charting, and we'll explore that, how it works in the real world over the next few weeks when we look at all these different aspects. But for today, let's just talk about what are the three basic principles behind technical analysis and charting. Okay, first of all, we have the idea that market price action discounts everything. So wherever the market is trading now, you know, the buyers and sellers, through their actions, have decided that's the fair market price for that particular instrument. So all of the hopes, fears, expectations, they're all factored into the price right now. To use an example from the world of stock markets, you may hold a share. The share comes out with great results, but you see the share price fall. This can be baffling to a lot of people. But if the market was expecting good, solid results, chances are the share price was rallying into that results announcement. So this is, you know, one way where we can see that market price action, you know, discounts a lot of the news that's going in. So the assumption is that everything we need to know is there in the price. That's not to say, you know, you have to ignore the news and ignore economic announcements, but it is a basic part of technical analysis. Now, one of the other things that I've discussed various points over the last few months, markets move in trends. It's very rare that we see a market trading there and then suddenly bang, it's up there. So markets take a while to get to wherever they're going to. And this is in all sorts of time frames. So just to prove the point, let's take a look at three different markets and three different time frame trends. So let's look at some long, medium and short term trends. So here, it's an obvious one. It's the Dow Jones going back to January 2016. I think it's fairly clear what the trend has been since then. And this has continued into September 2017. You know, we've seen a market that since the financial crisis has just continued to rise. And when it comes to a more medium term trend, depending on how you class medium term, here's a good example. This is the price of gold from the 8th of September through to the 29th of September. So we've got a 3-week trend where clearly, despite the odd rally along the way, the price of gold has edged lower from 1360 an ounce down as low as the 1280 area. So there's an example of a medium term trend. And to wrap up the whole trend thing, here's a complete different market again. This is euro dollar. This is from today when I'm filming it. So from 5 to 4 in the morning, but you can see since about 7 o'clock, since the European session started, we have got a definite short-term trend for euro dollar and one again that's paused. But again, over the last couple of hours, we've seen this market move higher. So short, medium and long-term trends. The third assumption is that history repeats itself. So levels that were important in the past can often be important in the future. It may not exactly repeat itself, but if we saw a market, gold or the euro dollar or the Dow Jones, fall to a level where suddenly sentiment changed, the buyers came back in, this is an important area for chartists. So again, I think the best way of illustrating this, let's look at some real life examples. So let's go back to the charts. Let's quickly explore this idea of history repeating itself. Maybe not exactly, but in ways we can take advantage of. I'm going to stick with one market and we're going to look at different time frames. This is euro dollar. Let's look at what was happening towards the end of 2016. The market hit a low, traded down to 103.40, rallies, and about a couple of weeks later comes back to it again, 103.40, that level holds. So that was something that played out over a 2-week period. Let's see a similar thing happening again here. The market comes to a level, February 2017, and about 6-7 days later comes back to it, that level holds again. But then the market moves a long way away, so it goes from 104.80, rallies up to 109, so that's a 400-point move in euro dollar. Sells off, now doesn't get back right back to that level, comes within, I don't know, about 50 to 80 points of the previous level, but once again the buyers come back in. So this whole idea, previous levels can be important, and you can see it happening just during September. We'd seen a big sell-off towards the end of September, relatively big, following the German election. The market sold off for the first half of the week, but these old levels where buyers had come back in during August, around about 116, 116.50, have once again, so far at least, proved to be something of a floor for euro dollar. Let's look shorter term. So here's a much shorter term example. Then it happened over the previous couple of days at the time I was recording this. Look what happened. We saw 27 September 2017, the market has slipped down to around about the 117 level. And then, this is about 1 o'clock in the afternoon. Then, a day later, in the early morning of the next day, the market had rallied, had pulled back, but once again, we've seen finally sentiment start to change. We've seen buyers come back in again at 117. So an example where history does repeat itself. Clearly, this doesn't work all the time. Like I say all the way through this part of the tutorial, and we see levels break, but they can give us an idea as well that sentiment is still, in this example, negative. But I think there's a couple of good examples there, sort of longer term and fairly short term, where we do see this idea of history repeating itself playing out in the markets. So that's it. That's the basics dealt with, the basic principles behind this. What are the advantages of using charts? Well, you can follow lots of different markets. If you're a trend follower and the market, let's say dollar yen, that you're following isn't trending, maybe there's a great trend in gold, or maybe there's a great trend in the S&P 500, the US stock market. So you can apply these different approaches to different markets. If you're trading off the trends and off the charts and you decide a level is important and the market is not going to get past that level, and the market does, you have no excuses to hold on to your position. So I think in a way we can use the charts to try and enforce the all-important discipline of trading. So there's a couple of advantages with, of course, the disclaimer, nothing works all the time. So don't go into this thinking that if you can just get all your settings right, you're never going to have a losing trade. Because the important part, another important part, I think, of using charts and looking at levels, looking at trends, is it can help us when it comes to setting stop losses. But we'll develop on all of this over the coming weeks. But this week is just to set the scene, talk about the basic principles. Next week, we'll get into some of the first nuts and bolts of chart analysis. As usual, if you have any questions or stuff you'd like us to cover over the coming weeks, just leave us a message in those comments down below. If you like the video, click the thumbs up, and to make sure you don't miss out on the various episodes of this course, if you're not subscribed, if you click that button there, you'll get automatically subscribed and notified when the next one gets uploaded. But for this week, for the start, that's it, I think, from me, David Jones, and Trading 212, and we'll be back within a week's time with the first lessons.